Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode we're talking about the liquidity crunch facing the U.S. banking industry over the last month, the fears of contagion that has spread to some other institutions, and what that means for the health of U.S. banks, future bank strategies, and investor sentiment towards the sector as we head in the first quarter earnings season. Coming back on the show to talk to us about what has transpired and importantly what could be coming is a terrific guest, KBW CEO Tom Michaud. Tom, thanks for coming back.
Nathan, great to be with you again.
Tom, I wanted to start kind of at a high level of two of the key events that kind of set things off of the last few weeks. And that would be the failures of Silicon Valley and Signature. And I know you've said this before, that the idea that these were kind of idiosyncratic events. Now that we've seen things kind of play out a few weeks, do you think that that still is the case? Or do you think that there is risk that maybe this is the beginning of contagion sort of spreading across the industry?
I think in terms of the here and now panic aspect that we had shortly after Silicon Valley and Signature banks failed, I think that contagion aspect seems to have calmed down and that there appears to be stability out in the industry. And I say that because, number one, I think that banks have had a chance to really build very good reservoirs of liquidity, which I believe is going to make a very big difference if there's any kind of a surge in sort of withdrawal requests. So I think that number one is that banks have now planned for something like that, number one. And then number two is my understanding from what I've been hearing the banks say and what you see in the numbers in the H8 data that's come out now is that the outflows have generally kind of stopped due to the failure of Silicon Valley and Signature Bank. So my sense is that those are two really strong forces that hopefully mean we won't have more near-term contagion. But I think that there are other questions that come up about what this means on a medium and longer-term basis. And I think that there's going to be some really spirited debate as we go forward as to what this might mean for the banking industry.
Sure, and I definitely want to get into that more because I think that is part of the biggest piece of this topic. But on the fear part, I think that's an important point to illustrate. And as you highlighted, the H8 data kind of shows it that, sure, we had faced outflows, but what was different is suddenly you had a crisis of confidence kind of spread across a few institutions in particular, and that fear was driving the equation rather more fundamentals. But I think I just sort of hear you say that the data we've seen recently kind of suggests that fear has calmed down a lot.
Correct. I think that it has. Now, there are some institutions still that may have been relying heavily upon held-to-maturity accounting for bond portfolios or may have a very high, unusual level of uninsured deposits, not because they run the bank in an unsound manner, but mainly because they're a commercial bank, because they tend to have bigger deposits. And I think some of those institutions probably will be taking extra measures, but the preponderance of the industry, it feels to me like things have stabilized for them.
And on those two metrics, it feels like it's almost been kind of a screen that some of the more bearish folks out there were using to kind of say, where could there be risk lying? So perhaps they're getting more focus. Is that kind of a fair way to?
Correct. And I think those banks that are in that category are probably hard at work looking to correct it and to make sure that the marketplace feels more comfortable with their positioning.
And the other thing I want to pick up on that you talked about what banks had done beyond even those institutions was they had found ways to shore up their liquidity. Certainly we've seen the bank's term funding program, the discount window borrowing, but also one of the things I feel like you've seen a lot of institutions do a good job of is come out and say, here's what we've heard from our big depositors. Here's our borrowing capacity from FHLB. Is that kind of some of the things you're talking about?
That 100%, I think grabbing collateral across the balance sheet to have other sources of liquidity is one. And also, there's been a lot more sophistication around sharing deposits around the industry to gather more insurance coverage. And so what you're seeing is that banks are able to use ICS and other services. They're really using technology to help them have a bigger insurance footprint than what they might normally have just on their own. And so I think that that's going to be a big part of the conversation going forward around how banks can multiply deposit insurance to make sure that their customers, especially in the commercial arena, feel very comfortable.
Right. As you put it, having large deposits, not necessarily anything wrong with the business model. It just means you have large customers. But what you're talking about is here's a way to ensure extra level of safety, confidence. Should there be any viability concerns or even kind of whiffs of it, they can say we have a solution that means that you're fully protected.
Correct. 100% correct. That is true. And look, the commercial banking model has most recently been more profitable than the retail banking and consumer banking model. And so it certainly isn't a bad model. It just tends to come with larger deposits.
Right. Well, I want to talk about outflows sort of broadly, and we talked about the H8, but I'm kind of curious what you're hearing, what you're seeing from clients, and maybe what kind of assumptions they've had. Do you think we go back to a level of maybe what we saw in 22? Sure, we saw deposits decline, I believe about 2% across the industry, which is not a normal year, certainly, but it's a far cry from seeing big swings. Does that feel like where we go back from in your mind in terms of customers slowly moving out the higher yielding alternatives?
I think we're in for a bumpy ride in terms of deposit outflows generally. And I believe that's the case because our analysis suggests that there still is about 11% of the industry's deposits, broadly speaking, are surge deposits that are still in the system left over from COVID, from the fiscal stimulus and the monetary stimulus, quantitative easing that happened. And what's happened is that every time the Fed has raised rates, it's made government securities more competitive with bank deposits. And so remember, at the back end of a rate increasing cycle is when deposit betas go above the cumulative median. And we're entering that moment, I believe, where it's going to be bank-to-bank competition some, but it's more the Treasury market and the yield curve that's going to be competing with banks. And so you're going to see more money, we believe, moving more funds out of deposits and into money market funds, typically, unless banks really move their rates higher to make them competitive. And I think we're back on that path now. And I think that deposits would have been down, even if Silicon Valley and Signature Bank didn't happen. I think deposits were going to be down this year.
Right, just simply the dynamic that it's when you've got institutions offering 1% on interest-bearing deposits or give or take there, and there's 4% in the Treasury market or the money market, that's quite a big spread.
It's a very big spread. The money market rate's been around 4.5% most recently, and I think that's just very competitive with what the banks are offering. And so it shouldn't be surprising that there's been a migration of deposits into the securities market.
So what does that do to betas? It clearly means they're higher, and you alluded that too. But does the firm have an opinion of how much higher they are sort of broadly and what kind of expectations are built into earnings assumptions for the group?
My sense is that this is just one part of the overall story where I believe we're likely to be reducing estimates as the year plays out. We're due actually very shortly after you and I do this podcast to release our preview report for the first quarter And I think that for most analysts on the street, the view will be that bank balance sheets will be a little bit smaller, margins will be a little bit tighter, and also in the back half of the year, I think we're likely to see credit costs start to move off of zero. Remember, it shouldn't be a shocker to everyone that credit costs are going up. I think it's been more of a shock for how long they've been zero. And so we're likely to move towards, I believe, a more typical, we probably wouldn't even get all the way to what might be typical, but we're going to see, I think, a higher level of provisioning and charge-offs as we get closer to year-end, in my opinion.
It just seems like we have to, for even just the simple reason you just put. We've been next to nothing. And one of the dynamics there is now is that with CECL being what it is, we're going to take a more forward-looking approach. And you have to think today, even if you have a pretty positive view, and the underlying economy seems pretty positive still, it's more uncertain than it was. And there was already sort of mild recession built into a lot of models out there. So, as you said, sort of coming off of zero, it just sort of seems like it has to go up a little bit.
Yeah, that's right. So I think, and what's very, very interesting is, before we got to this moment, before we got to Signature and Silicon Valley, bank stocks were trading at a 15-year low on a PE basis. And I think a lot of that had to do with the fact that investors didn't really trust the E. They really didn't trust the earnings estimates. And sure enough, I think the market was right in the sense that the PEs were actually a little bit higher. Now, I don't think the market knew that how exactly it was going to play out, but earnings estimates are likely to go lower, not higher. So the market has already anticipated some of this.
Sure. What do you think about valuations, though? I mean, even if you take down the E considerably, 15% or so, let's say, you could argue that from a historical standpoint, some of the multiples look pretty cheap, particularly if you're looking at some of the guys who've gotten caught up in this. And I'm not saying the ones who've put out necessarily numbers of significant outflows or, real change, but just kind of broadly speaking, you've seen some pretty stiff corrections.
I think some of these stocks are incredibly attractive. And as long as you can be willing to ride out the next 6 to 9 months. And my opinion is that most banks will not cut their dividend. Even some of these dividend yields that you can see at 6 and 7% look remarkably attractive to me. We don't need banks to increase them. We just need them to pay them. When you look at the capital accounts of these banks, I think most of the banks are going to keep their dividend. You could buy it just for that and then let this moment play out and get a great return in the next 18 to 24 months. The other side of this, though, is that we're going to get some choppiness. We're going to get new FDIC proposals for insurance on May 1st. We want to see how credit plays out. We want to see what happens to the economy. And I know investors like more certainty. But once the rally starts, it'll be quite sharp, in my opinion, because the valuations look incredibly attractive for the average bank. And I have always found that in my career, the number one strategy is to buy the trophies when they're on sale. And there are a lot of really high quality companies and banks that are on sale at the moment. And again, the stocks could be flat for 6 to 9 months, but if you can be a long-term investor, my instincts are these stocks, you'll be happy you bought them 24 months from now.
You mentioned capital, credit and liquidity and pressure on earnings, obviously, being on investors' mind and waiting for more certainty there and the economy. Are you hearing concern about changes in regulation from the investment community? We know already from the regulatory community they're talking about some things. Is that something, though, that's coming up in a lot of conversations?
I speak to investors quite often, and investors ask me many times, what's going to happen to the profitability of the industry when this is all settled and when we see what comes out of Washington? And my hope is that we don't get a dramatic hard turn in one direction or another after what's happened, and that while there do need to be some adjustments need to be made, my sense is that there will be a regulatory ratio that includes more mark-to-market on securities portfolios. I think there's absolutely going to be more focus on concentration everywhere in the loan portfolio, in the deposit base, in individual customers, industry segments, and so I think there'll be more of that going forward, which isn't necessarily all that bad. And I think a lot of that focus may happen by managements themselves, even without regulatory influence. So my sense is that things will be different if this contagion does not spread, which I think that there is a good likelihood that that's what happens. Then I think the sort of rage to have dramatic change will decline some. And if that happens, then hopefully we'll get a more rational discussion. And I think the rational discussion has to lead towards what is the future of the mid and sized banks in particular. Because if you look at the big banks, let's just broadly say they have 60% of the deposits. The big banks don't make 60% of the loans to middle market and Main Street America. And who's going to make those loans if the implicit guarantee from the big banks is so strong that it takes deposit share away from these mid-sized banks? Now, the good news is I don't think that's happening, and we're 2 weeks beyond the Silicon Valley failure, and it looks like that immediate trend has stopped. So if that's the case, that's good news. I think that there are corrections that could be taken in the deposit insurance design. I'm a fan of voluntarily allowing banks to buy more from the FDIC. I'm also a believer of increasing the cap, and I'm also a believer of possibly having unlimited sort of transaction account for operating accounts across America for all banks. And I do think that this implicit guarantee for the biggest banks is something that is a headwind for the rest of the industry, and is something that policymakers should think more about.
I want to pick up on a few things that I thought were great points. I'm a little surprised we haven't talked more about buying in more insurance, because we saw that coming out of the financial crisis, right? The transaction account guarantee program, it worked. And something like that, dusting that off, seems like it makes a lot of sense. And your point on concentration, another one, we focused a lot on asset concentration. Deposit concentration seems like a logical place to go. And from what we could tell, the reason for it would be that Silicon Valley was an outlier, and it still seems like they're an outlier there. So that wouldn't be necessarily anything that draconian, it seems like, for the rest of the group.
Yes, and also, too, just the speed at which the deposits flowed out of Silicon Valley is just staggering. And so I think that we also need to think about how the plumbing, for lack of a better phrase, of the assistance is put in place. So the Fed is the lender of last resort in a world where social media can really create excitement or interest, not necessarily in a positive way, but create concern around a banking company. And banks are built on trust. And we shouldn't be surprised that we had a little bit of a mini bank panic run, because some of the studies I've read have suggested we've had 10 of them in American history. So about every 25 years, this happens. And it doesn't mean that the banks that can be subject to it are bad banks or risky banks. It could just be that they're in an area where depositors are concerned at that moment, and now at a click of a mouse you can move your deposit. This is when you need orderliness. This is why we have a central bank and an FDIC. And so I hope that's part of the discussion as well.
Absolutely. No doubt about it. We talked a little bit about Q1 earnings. What do you think we're going to hear from management teams? And maybe even more specifically, do you think we're going to get more in the way of disclosures around some of the metrics we're talking about here? We've had some of that in terms of regulatory data, but beyond that, it was sort of ad hoc. Do you think we're going to see a lot more in the way of sunshine is kind of the best disinfectant?
I do. do, and especially the banks that think they're in a good position are going to be more than happy to disclose it, that's for sure. And most of the industry is in a good position, so I think there'll be plenty of interest in disclosing things like uninsured deposits to total deposits. But I also, what I can tell you, for example, around that ratio is banks really hadn't paid a lot of attention to it. So a lot of the services that you can buy to gather that data, for example, would include municipal deposits in uninsured deposits, but when they were over the limit. But what they didn't realize is that many states have collateralization requirements or funds in place where those deposits are collateralized or insured by a state. So banks are going to, I imagine, are going to spend the time to really peel it back, the layers, to make sure that investors in the marketplace know how much is not insured. And I know that a lot of banks have spent a lot of time educating their own teams to communicate with clients, to understand ways to use this ICS system or other systems to get more insurance. So I think that the bank managers are operating their banks and they're trying to close that gap. And I think that a lot of these ratios are going to be hot topics on the quarter. I also think that with the stock prices selling off, we're going to go through what we normally do when this happens. Are there going to be any goodwill write-downs? Are there going to be any core deposit amortization accelerations because of what's happened in the deposit base? So those will be thought of as one-off. My own instincts are we may start to see some disclosure in 10Qs about classified assets, and you may see some of the early pickup on credit quality, but this isn't going to be a big credit quality moment, in my opinion. I think that'll probably grow some as the year unfolds, but I think that investors, given what happened, may actually feel a little better about the Main Street America banks. And I think they'll feel good about the biggest banks, too, as well. I think the solidity of their balance sheets will be apparent when they report earnings.
Well, in closing, what do you think this all does to M&A and capital raising activity? On the former, and I know that's a big question, but on the former, it's been one of the slowest years we've seen. We started off slow for a variety of reasons, rate marks, concerns about the economy, and then you add on to it even greater uncertainty. But do you think we get to a point where when you get a little bit more clarity on that, people get a little bit adjusted to valuation resets, that there's new motivations, whether it's looking to diversify our funding, that would be a driver of M&A, and on the capital raising side, do you think you could see some all fits of capital raises, or are we a little bit early on both?
First of all, M&A was slowing down because things were disorderly, and that typically slows it. And I define disorderly two ways. One way is in the stock prices, and number two is in the economy. So those were both reasons why M&A, as well as the regulatory pressures against M&A, even though I think some of it has been sorted out some. But so those were the pressures before. I think what just happened is more likely to increase the pressures for M&A activity. In particular, I think commercial banks are going to think long and hard about being more balanced and having more of a retail component. And they could get it in one of a couple of ways. They could buy it, they could sell to a bank that has a retail platform, or they could build it. So there are a variety of ways that they could get down that path. And then I think if regulation becomes more expensive, that always encourages consolidation for a couple of reasons. One is I think the regulators like to see banks get inside bigger banks that had already built the systems that as the way they like to see them. That's number one. And then number two, the cost of regulation is more efficient when you're in a bigger company. That could be a driver. So consolidation has been happening since the mid-'80s. The real question is just about the pace of it, but the powers in the industry have been driving it, just the economic powers, and I think that it'll come back. It's just a matter of when, not if.
Well, I think that's a great place to leave it. Tom, thanks so much for taking time to share your thoughts. We definitely appreciate it.
Nathan, great to be with you, and thank you for having me.